So now we will proceed and consider an illustration. I want to look at an illustration, and it reads as follows. The following information was extracted from the books of Faida Limited as at 31st December 2015. Ordinary share capital par value 25 shillings, 8% preferred share capital par value 24 shillings, 10% preferred share capital par value 20 shillings, and 10% debentures valued at 400,000 shillings. The value for ordinary share capital 800, the value for preferred share capital 600,000, the value for 10% preferred share capital is 400,000, and the value for debentures 400,000, giving us a total of 2.2 million. Right? That is the total value for capital. Additional information. The share prices as at 31st December 2015 were as follows. The par value, the market value for ordinary shares 30 shillings, the market price per 8% preferred shares 20 shillings, the market price per share for the 10% preferred shares 25 shillings. The market value of the 10% debenture on 31st December 2015 was 500,000. The corporation tax rate is 30%. The company, number 3, has maintained payment of ordinary dividend per share of 3.8 shillings over the past 5 years. Required. 1. Cost of ordinary share capital. Number 2. Cost of 8% preference share capital. Number 3. Cost of 10% preference share capital. Number 4. Cost of 10% debentures. So we need to calculate the cost of every component, the cost of each and every component in that illustration. That is the question, and that can be done because all the information in the question has been provided. So what we need to do is to know, first of all, we need to know the formula for each component and the formulas we have given. Then number 2, as for the debt, we need to determine, is it a redeemable debt or is it irredeemable? So from this question, part 1 requires us to calculate the cost of share capital. Okay. Solution. Part 1 of the question, we are required to calculate the cost of ordinary shares. The cost of ordinary shares. KE. So one important thing to determine before you calculate the cost of ordinary shares KE, you need to check from the question, is this firm a zero growth firm or constant growth firm? That one should be provided, information should be provided in the question. The question should direct us as to whether the company is a zero growth firm or a constant growth firm. Now from the information here, there is no growth rate provided, which means this is a zero growth firm. And note number 3, if I'm to read it, it says that the company has maintained payment of ordinary dividend per share of 3.8 shillings over the past 5 years. So every year the company has been paying 3.8 shillings every year for the last 5 years. So there is no growth. So this is a zero growth farm, and the formula for a zero growth farm is DO or D1, expected dividend per share, over the market price per share. Market price per share, P naught. So with that, we multiply by 100 to get the rate, which is our D1 is 3.8 shillings per share, divided by the market price is provided in the table. Under additional information, the market price for ordinary shares is 30 shillings. Then multiply by 100, that will give us the price. So taking my calculator, scientific, 3.8 divide 30 times 100. It's 12.67%. So this is the cost of ordinary share capital. Then part 2, what is the requirement? We are required to calculate the cost of 8% preference share capital. Cost of 8% preference share capital, preferred stock. We have two categories, the 8% preferred stock and the 10% preferred stock. These are different because the first one, the shareholders are paid a dividend of 8% per share. The second one, 10% per share. So 8%, that is K, cost of preference stock for the 8% will be equal to the dividend per share, DP over PO, times 100. So what is the dividend for the 8% preferred stock? The dividend for the 8% preferred stock, the dividend is 8%. This is the dividend. This is the return that these preference shareholders are expected to earn, 8% on every stock. So 8%, and you can see that from the first table, 8% preference share capital, par value 24 shillings. Par value 24 shillings. So that is the par value. So the dividend per share will be the rate of 8%, 10% times 20, that will give us the dividend per share. Divide that by the market price per the 10% preference share is 25 shillings. 25 shillings. Multiply the answer with 100. That will give us the cost of preferred stock. So 10% times 20 is equal to 2 shillings. Divide 2 shillings by 25. That is 0.08 times 100. The cost of preference stock here, 8%. 8%. So that's how to determine the cost of the preferred stock. Then moving on to the other part of the question, cost of debentures. Cost of debentures. The cost of debentures. Cost of debentures. That is number 4. Cost of debentures. KD. KD, again, for debentures, remember, there are 2 categories of debentures. Number 1, the perpetual debentures or the irredeemable debentures, and the redeemable debentures. Redeemable debentures have a maturity period. Irredeemable debentures are meant to be used in the company until liquidation, until the death of the company. So the formula again is determined by the category. For irredeemable debentures, we gave the formula, so we need to check from the question, are these debentures redeemable or irredeemable? And the only information we have here, we are told that 10% debentures amounted to 400,000, that is the par value. Then the other information provided as far as debentures is concerned is that the market value of the 10% debenture on 31st December 2016 was 500,000. So there is no information that would indicate that these are redeemable debentures. So the assumption here is that these debentures are perpetual. They are irredeemable. So the formula for irredeemable debentures is equal to the interest over VD, all right, times 100. The interest over the market price times 100. So what is the interest? What is the interest? The interest is 10%. The interest is 10%. So 10% of the par value, that will be the interest. So 10% of par value of 400,000, that will give us the interest. Then divide by the market value. The market value below the table under note 1, I read the market value of the 10% debenture on 31st December was 500,000. So we divide by 500,000. Then we multiply that by 100 to arrive at the cost of debentures. Cost of debentures. So 10% of 400,000 is equal to 40,000. That is 40,000. Divide 40,000 by 500,000. 500,000. The cost here is 0.08 times 100. That will give us 8%. But this 8% is before interest. Is before interest. So KD before tax, I mean. This is before tax. KD before tax is equal to 8%. But we remember we say that interest is a tax allowable expense. So KD after tax, KD after tax will be equal to interest, all right? Interest times 1 minus T. Components, there are 3. The first one is equity. The first component is equity. We said when analyzing the cost of equity KE, we look at it from 2 perspectives. Number 1 is the zero growth firms. Then number 2 is what we call constant growth firms. Constant growth firm. So the cost of equity for zero growth firm KE, you have said, is equal to D1 over PO minus F times 100. That is for zero growth firm. For constant growth firm, we have said that the formula KE will be equal to the dividend per share over PO, which is the market price per share, minus flotation cost, plus G, which is the growth rate, times 100. Converting this into percentage. Then we have also discussed the preferred stock. This is A. B, we talked about preference share capital. Preference shares, and you say that the formula for preference shares will be equal to KP, which is equal to D1 over, that is DP over PD or P naught times 100. So it is simple. Take the dividend per share, divide with the market price per share, multiply by 100. Then the third component that we have discussed today is the cost of debt or debentures. Cost of debt or debentures, KD. And we say that just like equity, debentures are in two categories. We have the redeemable debentures. We have the irredeemable debentures. Number one, irredeemable debentures. Irredeemable debentures. And the formula for redeemable debentures is KD is equal to interest over VD 1 minus T. 1 minus T. That's how you determine the formula. Then we have discussed again the other category of debentures, which is the redeemable debentures. Redeemable debentures. These are debentures with a maturity period. They are expected to be bought back after a certain period, and you say that the formula is equal to KD interest plus 1 over N into M minus VD over 1 over 2 into M plus VD times this you multiply with 1 minus T. Okay, so that is how what we have learned today. That is the first formula which you need to master. So you see I have a brand blue pen. This is a brand new blue pen. That is the second formula. The third formula you need to master, need to memorize. Then we have that other formula for irredeemable debentures. And lastly, you have this formula here. You have that formula which you need also to master for redeemable debt. So that is what we have learned today.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.